Hello and welcome to the July 7th, 2023 episode of Watching the Tape. A lot of times in response to questions from clients and prospects, I find myself starting the answer with a rule of thumb and then tailoring that response based upon the unique circumstances of the person asking the question. Rules of thumb are great because of their simplicity. They are easy to absorb and remember. According to the dictionary, a rule of thumb is a general principle regarded as roughly correct but not intended to be scientifically accurate. Let's run through 3 personal finance rules of thumb.
Your stock weighting should be equal to 100 minus your age.
Stocks are the growth engine of your investment portfolio. The idea behind this rule is that the younger you are, the more time you have to ride out the ups and downs in the stock market. Alternatively, the older you are, the shorter your time horizon is, which means that investing more in bonds, the more stable asset class, would be more prudent. Let's run through an example. For a married couple, both aged 50, this rule would have them in a 50-50 portfolio, 50% stocks, 50% bonds. But there are several other factors that need to be considered. Let's look at some factors that would justify a stock allocation higher than 50%. First, the couple is very healthy, and both sets of their parents are alive and well. Next, let's say they have a high tolerance for risk, meaning that they fully expect that stock prices could fall 20 to 30% at any time. Their investment portfolio is large relative to their expected lifestyle needs, indicating that they'll have plenty of wealth left over at their passing to be transferred to their children and other beneficiaries. And let's say they have pension plans. These factors could easily support a stock allocation of at least 70%, maybe higher. And there's also the flip side. What if this hypothetical 50-year-old couple instead just doesn't have the stomach for stock market volatility, and they plan to spend down their portfolio during their lifetime? And maybe their longevity outlook is poor. Reducing the stock allocation to 30 to 40% could make sense here. Some of you may have seen that a newer version of this rule is to start with 120, not 100, because of longer lifespans and low bond yields. Either way, I do like this rule as a starting point, but many other factors need to be considered.
4% is a safe withdrawal rate in retirement.
According to this rule, a newly retired person or couple can set their initial withdrawal rate at 4% of their investment portfolio and then increase that dollar amount by inflation every year. So it looks like this chart here. It assumes a $1 million portfolio. It's a $40,000 withdrawal in the first year. We assume inflation to be 2.5% for each subsequent year. And so that dollar amount is inflated by 2.5% each year thereafter. This is an intriguing rule because it attempts to address one of retirees' biggest fears. Will I run out of money? And I do like that it can be easily reverse engineered to help people determine how big their nest egg should be at retirement. For example, if you expect to need $50,000 in the first year of your retirement and you believe in the 4% rule, then $50,000 divided by 4% would give you a total portfolio required of $1.25 million. But I think this rule is inflexible and unrealistic. Retirees' spending profiles don't look like this. People are typically very active early in retirement, and then as activity diminishes over time, spending follows suit until medical costs kick in at much older ages, leading to higher spending again. Our financial planning software is far more robust and flexible than the 4% rule. Nevertheless, I am still drawn to it for its simplicity and will sometimes even refer to this table that Morningstar created, which incorporates a little more math. Let's say on day 1 of retirement, you expect to live 30 more years and your portfolio is 50% in stocks. According to Morningstar's expected returns for stocks and bonds, your safe withdrawal rate would be 3.8%. It's good to know, but I wouldn't advise using this as a rigid rule for the rest of your lives. Be flexible and revisit your financial plan at least once a year.
Maintain an emergency fund worth 3 to 6 months of spending.
I am fully on board with this rule, though I'd probably refine it to be 3 to 6 months of critical spending needs, because in the event that you need to draw on your emergency funds, you're probably not going to be going on a lot of vacations and you're probably not going to be dining out a bunch. Should it be 3 months or should it be 6 months? Which is it? If you're married and both of you are employed, then 3 months is good. If you're single or are married and only one spouse is working, then 6 months is appropriate. You can safely park this cash in a money market fund earning about 5% or in treasury bills earning a bit more than that. Call me if you need any assistance with that. That is it for this week. If you found this video helpful or interesting and can think of someone else who might benefit from the content, please share it. Thanks for watching. We'll see you in 2 weeks.